Welcome back to your regular scheduled program. So in the last video, I did a green screen and we actually went to treasurydirect.gov and I took you initially through the process of purchasing or beginning to open your account on treasurydirect.gov. So I guess next time we will purchase some. I'll already be logged in and then I'll do a green screen and we can purchase them together, okay? But for this video, we're gonna talk about T-bills. Now, how many of you guys have heard about T-bills? Maybe you have, maybe you haven't. But T-bills are short-term government securities, okay? They're issued by the Department of Treasury. Remember, we talked about the difference between the central bank and the Department of Treasury to raise funds for government operations. And I think they all kind of are issued to raise funds for government operations, but they're backed by the U.S. government. That's one thing, guys. I know we're all in tissy fits about what's going on in the U.S. government, but the U.S. government is going to make money. So these T-bills are short-term securities that you can purchase that are backed by the U.S. government, okay? They are quoted as one of the safest investments available, all right? So how do they work? Okay, they're issued at a discount. So you buy a T-bill for less than the face value, and then you wait the face value time, and that's called maturity, and you're able to get the full maturity amount, okay? There is no interest payments. So instead, it's a periodic interest that matures at the time of the date. So they appreciate over time, right? The maturity date meaning its max date. Now, T-bills in particular are short-term maturities. They mature within 4 weeks, 8 weeks, 13 weeks, it says 26 weeks, and 52 weeks. And they are risk-free. They are considered one of the safest investments, okay, because they are backed by the U.S. government, who is still alive and well and kicking, okay? Right now it's getting a trim, but it's still going. We're still flowing. The lights are still on. All right, so as an example, now, if you guys think about T-bills as being this short-term investment on your money, it is really an investment opportunity, especially if you receive a large chunk of money. Either maybe you sold something or you got some inheritance or, maybe you got a bonus, right? You would use this method to get a bump in your money risk-free. So you buy a $1,000 T-bill for $9.70. That's the discounted price. You wait the maturity time. Let's say the maturity is 4 weeks, 8 weeks, 13 weeks. And at the maturity date, you get the full $1,000. You get a 30% profit. A $30 profit, right? Now that's at $1,000, right? Imagine if you bought $5,000, $10,000 worth. You're literally essentially just getting a return on your money. And that kind of makes me think about the money that we do have and the money that we get, and how honestly us spending is the worst thing we could be doing, right? If I could have $1,000, buy a T-bill, right, for $9.70, get the full $1,000 back in return, I just made $30. $30 is not much, but this is all relative, okay? So how to purchase T-bills, how to buy them. You can go to treasurydirect.gov, which is our mantra for today, and purchase them directly from the U.S. bank. You can also purchase them through brokerage accounts. Fidelity, of course. Charles Schwab is one of them, as another example. And you can purchase T-bills through banks and financial securities that are FDIC insured, okay? The minimum investment for a T-bill is $100, and they are sold. Oh, I didn't even know that some of them are sold at auction. Isn't that interesting? But they're sold on a weekly basis. So if you had the large chunk of money, you wanted to kind of spread it out, you'd have to do that on a weekly basis, which is fine. So this is just give you a breakdown of the T-bills versus other Treasury securities, because there are 3 Treasury securities. These are 3 U.S. backed investments that you can buy from Treasury Direct. It's the T-bills, which are short-term, which we talked about being a matter of weeks. There's T-notes, which are mid-term, which can be 2 to 10 years. And then there's the bonds, which are long-term, 20 to 30 years. So Do they pay interest? So the T-bills, which are the short-term ones, pays no interest, okay? The T-notes, those are the midterm ones, they pay interest every 6 months, and the T-bonds pay interest every 6 months. So every 6 months, you'll start to see a little chunk in the midterm and in the long term, which are the T-notes and the T-bonds. Risk level. The T-bills are ultra low. Now, do you guys hear this? I know you guys are very risk averse. That means you don't want no risk in your life, okay? The risk level is ultra low for T-bills. For T-notes, it's a low risk level, and for T-bonds, it's still a low risk level. Bonds are your series ones, Series I, Series EE. Rate of return, okay? T-bills rate of return is lower. The T-notes rate of return is moderate, and the T-bonds rate of return is higher. Why? Because it has a longer maturity time. So let's go over the benefits. The benefits of the T-bills are the rate of return, which is backed by the U.S. government. It can be sold before maturity, right? So it's high liquid. Remember we talked a little bit about liquidity. It's a high liquidity. It's good for short-term cash prices, and it's better than a savings account, right? You can't get those kind of numbers in a savings account. That's why I said if you got a little bit of money, definitely should think about it. They're exempt from state and local taxes, but federal taxes do apply, right? Because we're dealing with the federal government. And if you're in a high income tax state, this is definitely something to think about, right? And it's ideal for the conservative investor, meaning the investor who does not want the ups and downs of the stock market, nor the way ups and downs of crypto. They just want something to put their little money in and get their little money out, okay? They're ideal. Some of the downsides being that they are lower returns than stocks and bonds, which we know, right? Also, in terms of inflation risk, since the T-bills are short term, 4 weeks, 6 weeks, 8 weeks, they may not outpace inflation. And that's something to the totality of this whole entire course that we're dealing with is what can you do to hedge against inflation? And T-bills might not be it because they're such a short time, okay? And what affects it? So the T-bills, they are affected by the market and affected by the interest rates, which can be a good thing because when Fed raises rates, your T-bill yields go up, okay? We talked about that. So problem sometimes is that there is higher demand for them, of course, and that the government uses T-bills to finance debt and manage cash flow. We did a video about how inflation is baked into our economic system, and so T-bills are used to finance the government's debt and manage cash flow. Okay, so they have an ideal. Who's the ideal person for investing in a T-bill? Retirees, people who are on a limited income. Conservative investors, those are people who are very risk adverse. Businesses and institutions, because it's a short place. I mean, they can park their payroll money in there, get a little return, take the money out, right? And investors seeking a safe haven. So that is the video on T-bills. Please feel free to ask any questions because T-bills are different than the T-bonds that we've been talking about, but they still have an investment value. Once again, please follow me on Instagram, InvestorProfessor25. Follow me on YouTube, InvestorProfessor25. And you guys have a good day.